Marcus is 31 years old. He just paid off $6,500 in credit card debt. He has $100 left over this month, and he is telling himself, I will start investing once I have more money, maybe next year. Here is what Marcus does not know. If he invests that $100 today and adds just $100 every month going forward at the stock market's historical average return, he will have $121,000 in 30 years. If he waits just 5 more years to start, $82,000. Same money, same discipline. Sharp gasp but breath intake dramatic effect. A $39,000 difference from one decision. In the next 14 minutes, I am going to show you exactly how to start investing with just $100, which account to open, exactly what to buy, and how to set it up in under 30 minutes today. Here is exactly what we are covering. Step 1. The one belief that stops most people from ever starting. Step 2. Which account to open first and exactly why. Step 3. What to actually buy with your first $100. Step 4. The strategy that turns $100 into a 6-figure portfolio. Step 5. The 5 mistakes that wipe out beginners and how to avoid every one. By the end of this video, you will be ready to make your first investment today. Let us get into it. Let me destroy the biggest myth in personal finance right now. You do not need thousands of dollars to start investing. This belief, more than any other, is responsible for keeping millions of Americans out of the market during the years that matter most. Here is the proof. According to Dallamp, roughly 38% of Americans own 0 stocks, not because they cannot afford to, because they believe they cannot afford to. And here's what that belief is actually costing. $100 invested today at the S&P 500's historical average return of 7% annually grows to $76,000 in 30 years. $100 invested every month for 30 years grows to $121,000. Total amount you actually put in, $36,000. That extra $85,000 is completely free. It is the market working for you while you sleep. But here is the number that shows the real cost of waiting. The cost of waiting just 10 years to start investing $100 per month? Sharp gasp but breath intake dramatic effect. $150,000. Not $150, not $1,500. $150,000 gone because of a belief that you do not have enough to start. In 2026, you can open a brokerage account with $0. You can buy a fractional share of an S&P 500 index fund for as little as $1. The barrier is not money. The barrier is the belief that you need more money first. Before you buy a single investment, you need to decide where to put it. And the account type matters enormously because it determines how much of your investment return you actually keep after taxes. Here are your 3 options, in the order you should use them. Account 1. Your 401k. Specifically, contribute enough to capture the full employer match. We covered this in the previous video, but to repeat the most important rule in investing, if your employer matches your 401k contributions, always capture the full match before doing anything else. A 50% to 100% guaranteed return on day 1 beats any investment available to any investor at any level of wealth. Contribute the minimum to get the full match, then move to Account 2. Account 2. Roth IRA. This is the most powerful investing account available to most Americans, and almost nobody under 30 fully understands why. Here's how a Roth IRA works. You contribute after-tax dollars, the investments grow completely tax-free, and when you withdraw in retirement, you pay 0 taxes on any of it. 0 taxes on decades of compound growth. If you invest $100 per month in a Roth IRA from age 25 to 65 at 7% returns, you have $262,000 at retirement. In a regular taxable account, the same investment at a 22% tax rate, you end up with significantly less after taxes. The Roth IRA keeps the full $262,000. For 2026, the Roth IRA contribution limit is $7,500 per year, or $625 per month. Income limits apply. Single filers must earn below $161,000 to contribute the full amount. To open a Roth IRA, Go directly to Fidelity, Vanguard, or Schwab. All three have 0 account minimums, 0 trading commissions, and fractional shares. Takes 15 minutes online. Account 3. Taxable brokerage account. Use this if you have already captured the full 401k match and maxed your Roth IRA, or if you want access to your money before retirement age without penalties. No contribution limits. No withdrawal restrictions. But investment gains are taxable in the year you realize them. For someone starting with $100, open the Roth IRA first. It is the most tax-efficient account available and the best long-term decision for almost every American under the income limit. Okay, you have your account open. Now what do you actually buy? This is where most beginners freeze. Thousands of stocks, hundreds of ETFs, crypto, options, real estate funds. Let me simplify this completely. For a beginner with $100, there is one category of investment that academic research, legendary investors, and decades of real-world data all agree on. A broad market index fund or ETF. Here's what that means in plain English. An index fund is a single investment that automatically owns a tiny piece of hundreds or thousands of companies at once. When you buy one share of VTI, Vanguard's total stock market ETF, you own a fraction of over 3,500 U.S. companies simultaneously. When the U.S. economy grows, your investment grows. You do not have to pick individual stocks. You do not have to time the market. You do not have to watch financial news. One fund, entire U.S. economy, done. Here are the 3 most recommended index funds for beginners in 2026. VTI, Vanguard Total Stock Market ETF. Expense ratio 0.03%. Owns 3,500 plus U.S. companies. One share costs approximately $270, but with fractional shares you can buy $100 worth. V0A, Vanguard S&P 500 ETF. Expense ratio 0.03%. Owns the 500 largest U.S. companies. Warren Buffett has publicly recommended this fund as the best investment most people can make. One share costs approximately 530 TAR fractional shares, let you start with $100. FDRO X Fidelity Zero Total Market Index Fund. Expense ratio 0.00%. 0 fees. Owns the entire U.S. stock market. Only available at Fidelity, and it costs you nothing to hold. If you are opening a Fidelity account, F0X. If you are opening a Vanguard or Schwab account, VTI or VOO. That is the entire decision. One fund. Set up automatic monthly contributions. Do not touch it. Here is what this looks like in practice. You put $100 into VTI today. You set up a $100 automatic investment every month. You do not look at it every day. You do not sell when the market drops. You just let it grow. $100 per month, 30 years, 7% average return, $121,000. The fund does the work. Your job is to not interfere with it. Now let me show you the specific strategy that turns a $100 monthly habit into serious long-term wealth. It is called dollar cost averaging, and it is the most powerful wealth-building strategy available to anyone at any income level. Here is exactly how it works. You invest a fixed dollar amount, say $100, on the same day every month, regardless of what the market is doing. When the market is down, your $100 buys more shares at a lower price. When the market is up, your $100 buys fewer shares at a higher price. Over time, you automatically average out to a lower cost per share than if you tried to time the market. And here is the crucial part. You remove emotion from the equation entirely. You do not have to decide when to buy. The automatic investment does it for you. Research consistently shows that investors who try to time the market, waiting for the perfect moment to buy, consistently underperform investors who simply invest the same amount every month without thinking about it. Now let me show you exactly what consistent dollar cost averaging does over different time periods. $100 per month invested in the S&P 500 at historical 7% average returns. 10 years, 17,308 times. You put in $12,000. Market added $5,380. 20 years, 52,997. You put in $24,000. Market added $28,997. 30 years, $121,997. You put in $36,000. Market added $85,997. 40 years, $262,481. You put in $48,000. Market added $214,481. Notice what happens. At 10 years, the market added about 44% on top of your contributions. At 40 years, the market added 47%. The longer you stay invested, the more the market does for you and the less your own contributions matter. This is why starting at 25 versus 35 is not a 10-year difference. It is a $140,000 difference. Time is the single most valuable asset in investing, and every month you wait, you spend some of it. Now let me walk you through exactly how to do this, step by step, in under 30 minutes. Step 1. Choose your brokerage. Fidelity, best for beginners, 0 minimums, 0 commission trades, 0 expense ratio index funds. Go to fidelity.com. Vanguard, best if you want to buy Vanguard's own funds like VTI and VOO directly. Go to vanguard.com. Schwab, good alternative with fractional shares and 0 minimums. Go to schwab.com. Pick one. Do not spend more than 5 minutes on this decision. They are all excellent. The friction of choosing is more expensive than the choice. Step 2. Open the account. Go to the website. Click Open Account. Choose Roth IRA if you are investing for retirement and earn below $161,000. Choose Individual Brokerage if you want flexibility to access the money before retirement. You will need your social security number, bank account information, and a government ID. Takes 10 to 15 minutes. Step 3. Fund the account. Link your bank account. Transfer $100. The transfer typically takes 1 to 3 business days to settle. Step 4. Make your first investment. Search for your chosen fund, VTI, VOO, or FZROX. Enter the dollar amount, $100. With fractional shares, you do not need to buy a full share. You just specify the dollar amount and the platform handles the rest. Click Buy. You are now an investor. Step 5. Set up automatic monthly investments. Go to the automatic investment feature in your account settings. Set $100, or whatever amount you can manage, to invest automatically on the same date every month. Same fund, same day, every month, automatic. Done. Total time, under 30 minutes. Total complexity, less than setting up a streaming service. Now let me show you the 5 mistakes that destroy most beginner investors, so you can avoid every single one. Mistake 1. Checking your account every day. Markets fluctuate constantly. On any given day, your investment can be up or down 1% to 3%. This is completely normal. If you check daily, you will feel anxiety on down days. That anxiety leads to selling. Selling early is the most expensive mistake in long-term investing. Check your account monthly at most. Quarterly is better. Mistake 2. Selling when the market drops. Every few years, the market experiences a significant drop. 20%, 30%, sometimes 40%. Every single time, it has recovered and gone on to new highs. The investors who panicked and sold during those drops locked in their losses permanently. The investors who stayed invested recovered everything, and then profited from the recovery. Your job during a market drop is to do nothing, or better, to keep buying at the lower prices. Mistake 3. Trying to pick individual stocks. Research from S&P Dow Jones Indices consistently shows that over 90% of actively managed funds, run by professional investors with research teams and billions of dollars, fail to beat a simple S&P 500 index fund over 15 years. If professional fund managers cannot consistently beat the index, you are not going to either. Buy the index. Stop trying to pick winners. Mistake 4. Waiting for the perfect moment. There is no perfect moment. The market is unpredictable in the short term. The research is clear. Time in the market beats timing the market. Every time, over every long period studied. The perfect time to start was 10 years ago. The second best time is today. Mistake 5. Investing money you need in the next 1 to 3 years. If you will need this money for rent, an emergency, or a planned purchase, it does not belong in the stock market. Keep 3 to 6 months of living expenses in a high-yield savings account, currently paying 4% to 5% APY in 2026, before you invest anything beyond the 401k match. Only invest money you genuinely will not need for at least 5 years. Remember Marcus from the beginning of this video. 31 years old, $100 left over after paying off his debt, telling himself he will start investing when he has more. Now you know exactly what that decision costs him. $39,000 if he waits just 5 years. $150,000 if he waits 10 years. You also know exactly how to avoid being Marcus. Open the account. Fidelity, Vanguard, or Schwab. Takes 15 minutes. Fund it with $100. Buy a broad market index fund, VTI, BOO, or FZ Rocks. Set up automatic monthly contributions. Do not touch it. That is the entire strategy. The difference between the people who retire with wealth and the people who retire broke is not income. It is not luck. It is a $100 decision made today, followed by consistency for decades. In the next video, I am going to show you the head-to-head battle between the debt snowball and the debt avalanche with real numbers so you can finally decide which strategy is right for you. Subscribe so you do not miss it. If this video removed the excuse that was stopping you from starting, share it with one person who is still waiting for the right moment. The right moment is right now. I will see you in the next one.